Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, the headlines that you've probably read through the day will tell you that the Reserve Bank of India kept the interest rates unchanged. And you probably heard RBI Governor Malhotra talk about why that was. Everything that he said with regard to the inflation, that is the rise of prices in the country, to the expectation of economic growth. But ultimately, I'm sure the question that you're asking is, mujhe kya? Why should it matter to me? Well, it does matter in the form of your investment strategy, and it matters in the form of any loans that you might take. So that's what we're going to talk about today. First and foremost, though, we are in conversation with two managers of fixed income in mutual funds in India, and we'll talk about what they made of the policy and what their expectation is going forward. Join me now is Mahendra Kumar Jaju, who's a CIO of fixed income at Mirai Asset Investment Managers, and Mansi Karia, who's the Associate Vice President and Fund Manager Debt at PPFAS Mutual Fund. Thank you so much to the both of you for taking the time. So it was a bit of a divided house here, I must say, and I'll start with you, Mahendra. We were anticipating, some of us were anticipating that they would do one more 25 basis point cut, front load it, and then shut shop. But they didn't do that. They paused because they said that they wanted to see this pan out for a little longer. But ultimately, was this along the lines of your expectations?
So, just for records, our expectation was that there will be no rate cut in this policy. And the statement today by the governor was exactly in line with his guidance in the previous policy. So therefore, I would say there is a fair amount of continuity in the policy today because he mentioned in the last policy that whatever space is available for the rate cuts has already been upfronted. And therefore, to the extent that inflation was lower than the projections in the last policy, or that the growth projections have been somewhat revised downward, was already factored in the last policy consideration when they upfronted the rate cut to 50 basis points. And since the last policy, every time there has been a public, comment from the Reserve Bank, they have always spoken about the Q1 FY27 inflation projection, which was at above 4%, and that has not changed in the current policy or today's policy also. So therefore, I think there was a little bit of gap between those who are expecting the rate cut versus those who were not. That the current fall in the inflation was already factored in that upfronted rate cut, and the forward projections for the inflation have not changed. On top of it, there has been heightened global uncertainty because of the ongoing, the recent development of the escalation in the tariff, negotiation bottlenecks that is currently witnessed between India and the US, as also the fact that the Fed has still not given any, definitive signal or a more comforting signal of possible rate cuts in the coming policies. So I think while there was a strong case purely based on domestic factors to cut rates further, I think there is still a huge amount of uncertainty on the external front, and that's where I think the next rate cut will have to wait. If there are more favorable developments on the external front, then I think the domestic environment maybe will want to or maybe warrant a rate cut in the next policy or the policy after.
Yes, interesting. Because the RBI governor, in fact, saying in a press conference that they don't have enough data, they don't have sufficient data to revise their GDP forecast at this point. And that is a pretty clear statement. Mansi, I'll come to you. So from that perspective, let's take the conversation forward a little bit. Not this time, but maybe next time. And where do you see the culmination of the current rate cycle? In that, how many more rate cuts do you anticipate, and where do you expect the repo rate to settle?
Thank you very much for having me in this show. I think RBI will wait for the transmission for the 100 basis point cut they have took in the last three policies, and the rate cut comes with a lag. The effect will come with a lag. So RBI will probably wait for the rate cut, and the tariff related risk has already priced in their growth projections, since they have not increased their growth projections for financial year 26, and it is unchanged at 6.5% in spite of inflation cooling down and the increase in the global uncertainty.
Okay.
We
So,
expect a couple of rate cuts by the second half of the year, and it again, as Chaju sir said, it is mainly data dependent how tariff uncertainty and the negotiations fare.
Mansi, just confirming, you're expecting repo to settle at 5%, right?
Yeah, by the end of the year, but I don't expect the rate cut in the next policy also. I think RBI will further be depend on the wait for the transmission of rate cuts for a couple of more policies also.
So then let's talk about what happens next, because ultimately the market moves ahead of what actually is occurring. It moves on expectations like anything else. So where are the opportunities, Mr. Jaju, on the fixed income side? How are you positioning yourself and your portfolios? And I would like you to talk to us also about the hybrid strategy, because let's face it, I think a lot of investors have gravitated towards hybrid in order to get their fixed income exposure. They don't go into pure fixed income anymore. And I think that's a little tragic, but then that's a conversation for a different day. So what is the strategy right now?
So I think when we talk about the strategy, let's break it down into two parts. Okay, first part is that whether there is a possibility of further rate cuts in the rest of this year or in the first half of the next year. And then if that rate cut happens, then what would be the possible impact on the market? As I mentioned earlier, that on the domestic front, it is very likely that the GDP growth rate will eventually turn out to be lower than the current projection. But as Governor said, at this time there isn't enough data to support that, and that is correct because analysts can project and revise. RBI has to be very, very careful in giving any projection. So it is natural that they will wait for more definitive data, whereas the market can maybe take an early call, which can go either way. So, assuming that the growth slows down or the inflation remains low or the tariff-related uncertainty is resolved positively, and that would definitely open up a space for a rate cut. So, therefore, there is a contingent event of external positive environment for the next rate cut to happen. We don't know how it will resolve, but I also expect that it will be resolving in our favor. Now, the second part is that in the last policy, when RBI said that there isn't much space to cut rate, the market reacted somewhat in a classic, copybook fashion, as I say. So, what is the classic copybook fashion that I'm talking about? When the Reserve Bank or when the central bank starts cutting rate, the yield curve tends to be very flat because the long end has already expected a rate cut cycle to start, and therefore the long-term rates have come down. When the central bank approaches the end of the rate cut cycle, the curve starts to steepen because the long end has already priced in. The short end starts reacting to the immediate action by the Reserve Bank of cutting rates and injecting liquidity. So once the market sensed that there isn't much space for a further rate cut, this is the classic copybook play that happened. The short end has corrected. Governor mentioned that the transmission of the policy has been very successful. The deposit rates have come down by about 80 basis points. The lending rates have come down by 65 basis points. Given the rigidity and the complexity of our system, that's a very massive transmission that has happened in such a short period of time. So most of the action happened at the short end of the curve. The short-term rates came down up to 1 year, 3 year rates came down, but the longer-term rates did not come down. Now, what happens when there is a additional rate cut, let's say in the next 3 months, 6 months, or 9 months? If the previous rate cut left very little space for additional rate cut, the next one is most likely going to be the last one. And therefore, in terms of the pricing of the yield curve, or as we say, in terms of setting the term structure of the yield curve, that last rate cut would not be very material from the long end perspective. Therefore, for projecting the long-term rates from now on, we have to look at factors beyond the rate cut alone. So that would be demand and supply balance, that would be the global interest rate environment, that would be the impact on, say, for example, trade deficit, or impact on the balance of payment because of global environment, including the tariff and other geopolitical uncertainties. And we have seen next to zero demand, or let me say very poor demand from the insurance companies and the pension funds in the last couple of months since the last policy at the longer end. In every single auction, the Reserve Bank has also given the market demanded yield. There's not been a single development in the last auctions, which could have indicated to market that there is a possibility for the rates to come down. So therefore, I think since the last policy to this policy, every signal that has come from the regulators has been to focus on the transmission at the shorter end of the curve and wait for more clarity at the longer end of the curve. And right. So just to conclude, therefore, I would say that the time for long duration or heavy duration strategy is possibly over. We had very good couple of years in the last 2 years. Now I think investors should focus on the accrual strategy, which means low duration funds, short duration funds, and those type of funds.
Okay. Okay, interesting. And that really is the key takeaway of this conversation as well. I wonder, Mansi, if you concur, and where do you find the sweet spot currently on the yield curve? So where are you deploying funds incrementally?
So current corporate bonds are at a sweet spot of 3 to 5 year corporate bonds, where the credit spreads are very high, and it is at the steeper end of the curve. That's where we find it attractive as of now. But over the long run, 3 to 5 year, the accrual strategy with a mixture of SDLs and corporate bonds, that's what we are looking for the opportunity.
Okay, all right. I think we've set the context well for the next chat, and thank you so much to the both of you for taking the time. Mr. Jaju as well as Mansi, thanks so much for joining me on today's program. All right, so you will be forgiven for finding some parts of the first conversation a little bit technical. But there are a few things for you to bear in mind. If you're not an economics student or a student of finance, then simply put, when you're talking about a corporate bond or a government bond, the yield, that is what you get through the interest, and the price, which is what mutual funds, or you in fact, but mostly mutual funds get when they buy and sell, is inversely proportional. So if the rates are going down, that is, if the Reserve Bank of India is cutting interest rates, then the prices of bonds that are already issued will go up. And generally, if you've already bought those bonds, you will make capital gains. The flip or the opposite of that is also true. That is the crux of the conversation. And what we learned from that first conversation is that there's likely to be maybe 1 or 2 more rate cuts in the rest of this rate cut cycle, possibly over the next few months. And what that means is that a large part of the gains that you have accrued have already been done. There's unlikely to be too much on the table for you to gain from this point, so you should gravitate towards the shorter end of the spectrum. Let's talk about what that means. I'm joined today by Karthik Zaveri, Director Investments at Transcend Capital. Karthik, I hope that I've explained it in a way that most people will understand. But I know that you're a whiz at this, so maybe you'll do a better job than me. Would you say that my interpretation is correct, that you should now gravitate towards the shorter end of the spectrum, and what options exist from a fixed income standpoint to do that?
So yes, you're absolutely right, Alex. I mean, that is true. At the same time, for all the viewers, whenever the interest rates are going down, it's basically good news, because you may feel a little shortchanged because now your deposit is going to earn lesser, your debt mutual fund is going to earn a little bit lesser and all of that, which is okay. But having said that, when rates go down, your home loan rate goes down, profits are higher for companies. So when you invest in equities, those profits are going to be higher and all of that. So it's always an all-round good news when the rate cut happens. And I was hoping that, a rate cut happens because we do have a very strong trigger in the name of tariffs right now, where Indian companies really need to focus a lot more on manufacturing and doing it at home. And if they can, get money at a slightly cheaper cost, right from the retail guy to the SMEs to the large corporations, I think it's an all-round good thing to have happened. If it's not happened this time, let's hope it's going to happen next time. But the cycle has definitely begun. So if you want to start making investments in this, okay, then this is a good area. If you want to, earn from corporate bonds and government securities, like Alex said, there is a little bit of risk there. I mean, if it goes against you, but now we are looking at a downward cycle, so it's only going to be a profitable investment to do.
Okay, but would you agree that most retail investors have now gravitated away from pure fixed income and moved towards hybrid strategies because of the tax treatment? And given what we know so far, what kind of investments would you say make sense to take advantage of where we are in the rate cut cycle with only one or maybe two more left?
Right. So having said that, yes, you're right that people don't like that, but it's not so much in my view because of tax. It's more because the returns itself are about 6% and which is in line with inflation, and that does not really help anybody's cause. So which is why people want to do hybrids. People have always wanted to do things like balanced advantage, which is like a conservative hybrid, so that they can at least earn about 8-9%. Tax treatment is efficient with those products because you get the benefit of long-term tax when you hold it beyond a year because they are classified as equity category. Then there are also, for the ones who want to go even to 10 and 11 and 12%, go to hybrid aggressive category. So that's also something that people are looking at. And the best advantage to be taken from a falling rate cut cycle is equities, because see, what happens is the effect comes after about 2-3 months. The moment interest rates are cut, everybody benefits. If you are looking to buy a house, then you will be motivated to go and get your loan right now because your interest outflow is going to be lesser. If you are motivated to raise a loan, your cost is lower. The same applies for a company. With interest rates going down, there is profitability increase for everybody because the interest itself is saved. So money saved automatically is money earned, and that is a benefit from the retail investor to a large corporation. So which is why I think you can look at all investments across the board. Even if you want to do gilt funds, if you're a pure debt fund investor, even a gilt fund is probably a good idea at this time.
Gilt fund being a government bond fund,
yes,
which only invests in government bonds. Karthik, the question is on repricing of loans as well. So a lot of viewers have home loans that are pending. They have a few other loans as well. What advice would you give on the repricing, and particularly if you are on, for example, the MCLR, which is the erstwhile way of determining the rates, which is the marginal cost of funds lending rate, which takes longer for repricing to take place. So if at all transmission has not happened and rates have not gone down on loans, it's likely that you are on MCLR. So what advice would you have about going to the bank and saying, hey, give me a better rate?
So first thing, you need to look at your loans regularly. Each time there's a downward revision, you need to go and check with the bank whether this revision has happened in your account. If it is not, they also give you the facility of making a small payment and shifting to the new system, by which you get an immediate impact. As soon as the rate cut happens, within about a week's time, you get the intimation and your loan is also repriced. If it also doesn't happen, nothing to worry too much. But in a month or so, in a 2-month period, they will do the rate, adjustment. But it's good time. So at this time, don't be in a hurry to prepay, because now we are looking at a good another 12 to 18 months of a down cycle in interest rates. So you will be saving automatically on interest costs. Your tenure will be coming down on its own. So don't be in a rush to prepay. And the fund that you might have earmarked for prepayment, if you are conservative, maybe consider corporate bonds and government securities funds. And if you don't bind the equity risk, can hold on for about 5 years or so, go to equities, because equities will also turn around. And we are at a very interesting time. We've had a sort of a correction. And as soon as this uncertainty with tariffs and all that moves away, you will see that, the stock market will reverse and you will again be back to making profits from equity.
Okay. You are saying not to prepay a loan And that's an interesting perspective. It is, in fact, what a lot of people advise. Can you break down why that is, though? And is it always true? For example, if you are in the first part of your loan and you're primarily paying back the principal, does it still make sense? And I'm talking about mortgage loans here, or home loans rather.
Yes, absolutely. So, Alex, what happens is when you have just about started your loan, for example, or you are in the first 3 years, then at that time, your principal payment is the least. Now, at that point of time, if interest rates are moving up, what happens is even lesser principal is getting paid. So, in the earlier years, yes, you must make some prepayments. But even if you are in the earlier years and the interest rate cycle is downwards, then you are not in a rush to make prepayments. So, just a simple rule of thumb is if the interest rates are moving up, keep a prepayment budget towards the end of the year or whenever you want to, because you will be automatically saving your tenure, you will be say, reducing your principal. When interest rates are moving down, never be in a rush to prepay. Invest your money elsewhere, then use the profits from there, and that time come and prepay your home loan. So essentially, rates are going up, consider prepayment. Rates are going down, don't prepay. And ideally, prepay from profits of equity investments and other investments so that you have your capital plus you are automatically also augmenting your loan downwards.
Yeah, that's good advice, because opportunity cost is what you need to bear in mind. What would you have done with the money if you had not prepaid? And this is a good point that Karthik is making. Now, the last part of this conversation, I want to talk to you about, Karthik, something that the Reserve Bank of India governor spoke about today. Now, there is RBI Retail Direct, which is a platform that they have started to allow investors, retail investors, to buy government bonds. Now, let's admit, it's not really taken off the way that it was initially envisaged, and people have not gone and bought government bonds themselves. People buy through either fixed income mutual funds or hybrid mutual funds which invest in these bonds. But now the announcement is that they're going to allow investors to buy treasury bills, which is any government paper that is less than 1 year in duration, on an SIP basis, which sounds interesting, but do you think that there'll be takers?
No, there will not be any takers for that. The reason for that is very simple. So long, I mean, it's not about RBI, it's not about treasury bond, it's not about government security, it's not about any of these facilities of SIP or anything like that. We have to fundamentally understand one basic about investments per se. So long as your money is 5 lakhs, 10 lakhs or lesser, you don't mind doing DIY by looking at advice that you get from the media, by reading whatever is written in the newspaper, so on and so forth. The moment you have a slightly higher amount of money, then everybody gets serious about it, whether it's a 25-year-old or a 55-year-old. And that's the time people want to talk to a human being and get that point of view ratified or a second opinion or actually work through a broker intermediary. So this is not like a travel portal where you can actually book a ticket very simply and you don't need a travel agent. Financial management is far more complex. So till the time there are no intermediaries or brokers involved here, this thing will not take off, because on their own, people will only do that much limited amount of activity. When there are corporations, and if we talk about direct funds, which is a direct connection here, that does well because a lot of corporations have their own departments and teams to invest here. And there is a collective of people who will invest into index funds. Those things can be direct mode. But when you have to do a strategy, a planning, an allocation, and all of that, you need another person, you need a professional to speak to. So without this, I don't really see this thing taking off.
Yeah, and the other aspect, of course, is that the tax treatment, and this is the last aspect. I don't ever say that you should determine your investment based on the taxes, but then there is no tax advantage for you to do this. You might as well look at a liquid fund or some other instrument so that you don't have to have the hassle.
Yeah, so that also, yes, you're right. Tax treatment is a big disincentive to come and make an investment. But at the same time, people have become that much wiser. Even the younger generation who's just about starting to earn also can make a comparison between a 6% and an 8%. So those guys have also, also been motivated to do an SIP. If you are not very sure, if you want to be very conservative, then people know that from their phone also they can do an SIP into something, a species called balance advantage fund, where the risk is controlled, your capital is reasonably safe, your money is participating in equity market. So even a 25-year-old on his app is doing things like
Absolutely.
that.
Good point.
So I think return is become the prima facie decision-making point for any investor.
As it should. Karthik, thanks so much for joining me today. Pleasure having you.
Pleasure.
And well, that brings us to the end of this edition of Your Money Matters. You might have questions at the end of this. Let us know in the comment section and we'll take it up in future episodes. This is NDTV Profit.